Ladies and gentlemen, it's Modern Investing on Pod TV. My name is Sasha Star. I would like to introduce our esteemed guests, uh, Dr. Milan Sombarak. Welcome to the show.
Thank
Hi,
you for
Milan.
inviting me. Delighted to be here.
It's great to have you. And Jim Ida from Ida Foundation. Welcome to the show, Jim.
Thank you so
Great
much.
to have you. So, as I said before, January, February are the best months of all year to make money. Question: Are you making money? Milan, would you like to start?
Well, let me start out, if you will allow me,
Yep.
by quoting David Swenson, who headed the Yale University Endowment, the most successful university endowment anywhere. And he stated, David Swenson stated, um, over a reasonably long period of time, there's almost no chance that you will wind up beating the index after taxation and inflation. Almost no chance of beating the index. Equaling the index is something that we can teach a high school student in less than 10 or 15 minutes. And I mention this all the time in these programs because there are now 18 hours of talking heads like we are here today on a daily basis. Doesn't mean that there's 18 hours of news. There's 18 hours of drivel and very little news. But the fact is that after taxation and inflation over a reasonably long period of time, David Svensson said you cannot beat the index. Very few people can. In fact, 40% of investors trail the market, which can be taught to a high school student how to equal it. And so that's the starting point for our core portfolio. It'll gain us about 6 to 6.5% after inflation, as it has done over the last couple of hundred years. So look at the past if you will define the future, said Confucius, so it must make sense. And so we recommend for core portfolios that to equal the index, which is a very simple thing to do, buy an exchange traded fund which tracks the S&P 500. But the best example is SPY, is the oldest and has the narrowest bid-ask spread, and that's the place to be. So anything else that we do is something that we should do in our fund portfolio, which for most people is not much fun. So
Basically, then I have to retract my question. Obviously, when I ask if you are making any money and you went into so-called process, which would be the best described in a book, if you would publish the book, The Investments for Dummies. I think everything what you are saying would be a perfect, ideal material for book Investments for Dummies. And you can make Investment for Dummies 1, Investment for Dummies 2, Investment for Dummies 3, then Investment for Advanced Dummies 1, 2, 3, then Investment for Idiots 1, 2, 3, 4,
Really stupid.
7, and then
that's right.
perfect.
That's it. Yeah. You don't have to be very smart. Yeah. The year has last year, the 2022 was the worst year since 2008. And this year is starting out very well. So keep in mind that the trend is our friend until it isn't. So it has started out very well. The year is looking very good. And so I hope that it's the beginning of a return to positive investment results. And so making money, people who hold the S&P 500 have made money this year. Yeah, it's up about, 6 or 7% for
Oh, 6, 7%. My investments in fund portfolio, mind you, unfortunately, made 80% in the last 3.5 months.
Tell us how you do it. We want to know.
So you would have to have a very long life to get 5-6% a year to get to the 80. What's your life expectancy?
No, that's a good point. No, excellent point, Sasha. Really, how long is that reasonably long period of time that David Svensson quotes? And that is really a market cycle from peak to trough to peak. That's a market cycle. And they tend to be somewhere between 6 and 8 to 10 years long. And so how much time do you have? Yeah, that's right. Good point. So a market cycle. And so we may be seeing the trough beginning to turn and move upwards, as indicated by what results we have seen so far in 2023. The first month of the year is behind us, and we've done very well. Hope it continues. It really doesn't matter, because what happens for people who have our mindset in their core portfolio, as the market goes up, they're taking profits. As the market goes up, most people are jumping on board and buying it when it's expensive. When the market goes down, most people are running for the doors. The same people who are looking for a cheaper loaf of bread and a cheaper automobile and a cheaper anything, when the market is cheap, they're leaving it in droves. So right now, things are looking very promising, and it really doesn't matter whether the market goes up or down. When it goes up, we take profits. When it goes down, we buy bargains, and we are always maintaining that asset allocation, which to a greater extent is responsible for overall results ahead of picking stocks or timing markets, none of which work reliably. There is a rules-based investing and a judgment-based investing. Rules-based investing, simple. Save. If you don't save, it doesn't matter. Number 2 is do it yourself. Number 3, history shows that you buy the American market as a whole and not pick stocks. Number 4 is buy and hold. Warren Buffett's favorite holding period is forever. Buy and hold. Number 5 is adjust to your asset allocation when market movements throws off your asset allocation, which should be roughly 50-50, 60-40. That's not really important. The important thing is to have one. And number 6 is avoid complexity. If you cannot explain an investment to a 10-year-old, 12-year-old, don't get into it. So those are rules. Rules-based investing works all the time. Judgment-based investing, there's stock picking. It works half the time because the buyer is right if the stock goes up. The seller is right if the stock goes down. In the short term, they cannot both be right. In the long term, it's possible there could be. But judgment-based investing is iffy much of the time. As I mentioned earlier, the average investor trails the market by 40%, primarily based on judgment, which is incorrect much of the time.
You know what I love about your series? One thing. So when you say average investor is losing 40%, so anyone who will lose only 35% should feel very happy about it. Because look at my neighbors, they all lost 40%, and I lost only 35%. I'm a great investor. I'm a genius. But anyway, Jim, what's your take on the markets? How you're doing these days?
Well, there's no question that 2022 hit both my core and my fund portfolio very hard. And the start of 2023 has been much more delightful. And I would say that the stocks that I bought and I thought they were unduly punished. A couple of them, one of them in particular, Slasher, we've talked about this before, NVIDIA, went down below where I bought it. But I didn't panic. I didn't get emotional about it. And now it's 20 points higher than when I bought it. So
I think I told you that that's going to happen.
In your fund portfolio, you need discipline, as Milan was saying, and not to be emotionally engaged. And yes, this was one of the first things that I learned. I'll just double down on what he was saying, is that people seem to buy when a stock is popular, when it's already been driven to a level that's probably not supported. And they tend to sell when people are selling, other people are selling. So they often unload when, trying to avoid the bottom. And the bottom is where I'm looking to buy. And any intelligent investor would be looking, buy when it's low and sell when it's high. But, you can do this when you track certain stocks that are unduly punished. They're sound companies. Their track record is sound. Their earnings are sound. But some bad news comes out, like with NVIDIA. All of the semiconductor stocks were punished. Another one was Taiwan Semiconductor Manufacturing. They were punished well below what they should have been trading at. And so I bought at that level. And yes, they went a little bit lower, but they came back much higher. So this is one of the investment strategies that I use personally in my fund portfolio. My core portfolio, I do what Milan was suggesting, was I look at the asset allocation periodically, or when the market is really tanked or really gotten higher, to check the asset allocation to see if it's in my comfort zone. I don't bother with the 5% here or 2% there. But if there's a market change, like I'm now 75% invested in equity and 25% in cash or cash equivalents, then I think maybe a time to adjust to my core portfolio. But most of the time, I don't worry about that. It's my fund portfolio because I'm interested in the market. And if you're not interested in the market, don't play it. Just invest. And invest, you have to have a long-term investment strategy.
Yeah, I'd like to tell you that I have my own theory about why people are selling when it's low. They're buying when it's high. It's obviously greed, because if it went so high and it continues to go higher, it's not going to stop right because I bought that stock. It will continue to go for some time. It's a momentum investing, and of course you cannot fight that. But that's understandable. Why people are selling when the stock going low and lower and lower and so on. And
oops, we lost Sasha.
He got disconnected.
Oh my goodness. Well, Nick,
and I was actually going to put in chess notation to the buy when high, sell when low. If you notice this, buy when high is a question mark, sell when low is a double question.
Blunder. Yes.
Wait, Sasha's back.
Sorry,
Sasha,
let me just finish.
Put your statement in chess notation. Buy when high, question mark, sell when low, double question mark. So now we have chess notation.
So why people sell when the stock low and going even lower and lower and lower? There is something, if you follow tennis, there is a certain thing which calls the scoreboard pressure. So that means when you're losing a set, and then you're losing second set, and let's say score is say 5-3 or 3-5, and you're serving, you're under great pressure, because if you lose your serve, it's going to be 2-0, and probably either it's the end of the match if it's 3-setter, and it's almost the end of the match if it's 5-setter. And there is tremendous board score pressure on you. So when the stock is going lower and lower, and you have read, say 3 figures and 4 figures, and then God forbid 5 figures, you are under tremendous pressure. And sometimes your question, am I the only idiot who holds that stock? Oh my God, let's sell it because it could go even lower. Okay. Now, of course, you should not be in that position, simply because if you follow William O'Neill 7% rule, you cannot be in that position, because once you got position in the stock and it lost 7%, you automatically sell. It's the end of story. You don't think, oh, you know what? Okay, it will drop 8% and then it will recover. No, you sell when it lost 7%. So if you will go to 8%, stay there, make a base, and will start going higher, then you jump in. If you still like the company and fundamentally it's good investment, yes, then you jump in and you buy it. So, Jim, the same thing with NVIDIA. If you, wherever you bought and you would lose 7% and you sold, so it went down big time to $120 and stayed there and slowly started to claw its way back. Then you could buy it back and still have your position, and you could probably save a lot of money by doing so.
Sorry, I would have made more money that way, but then it would be more stressful for me as well. I like to, when I do this kind of trading, I like to think in terms of the long run and not like a day trader. So
it's not a day trading; it's a month's trading. It's a month's trading.
Yeah,
because several months between.
It still is an active trader, and you have to be like, I don't notice when it goes to 7% because I'm not following it that closely.
Well, you can stop loss the moment you bought the stock.
Yeah, but you're right that I would have made money, and so if I wanted to invest the time to that, I would have made more money than the approach that I took. You're absolutely right about that.
Mm-hmm.
Interestingly, what you're talking about, Sasha, and you also, James, is the psychology of investing. You briefly mentioned, James, psychology earlier on today, but Daniel Kahneman, who is a psychologist, won the Nobel Prize for economics because of a book that he published talking about the influence of psychology on investor behavior. And it is not a positive thing. And if we can control our emotions, and very few people are able to do that, if we can control our emotions, we could do well in the markets. Actually, the American market has, without cherry picking, been the best place to invest for nearly 200 years, likely to remain so unless we make mistakes by the psychological aspect of our approach to investing.
This is a discipline that chess also teaches you. If you allow your emotions to cloud your judgment in conducting a chess game, you'll inevitably go wrong. You have to be objective, and the same objectivity is an important lesson in trading. You must be looking at something, and I think like you were both mentioning earlier, rules based, whatever it is. The 7% solution that Sasha's talking about, it's fine. If you want to trade like that, I'm all in behind you. I'm just not going to do that because I want to manage my stress level to a certain extent. That's a little bit, it depends on how comfortable you are and how interested you are in the market. And if you're very interested in tracking it very much, you apply different rules than someone who wants to have a little bit more hands-off. But the psychology that I have observed has been people panic. They panic buy and they panic sell. And those are opportunities for an investor like me.
Have you heard me say previously that chess is entirely a game of luck? If you're lucky enough to pick a weaker opponent, you will win more games than you lose.
Well, it's impossible in tournaments because
you get scared. I don't know how you do that.
You count your investments.
I really want to play a weaker player, please.
Yeah, I always seem to get paired. The more successful I was, I got paired against stronger players. It didn't work out for me.
Geek, how your investments are doing these days?
See, I have my professionally invested group that takes care of some of the stuff. And frankly, I don't even look at what they're doing. I just hope they're doing a good job. And then I have my fund portfolio, which I do look at and play around with. I pushed almost everything into oil and gas at the beginning of the year. And that was the only one of two asset classes that went up in 2022. So I kind of got lucky. It's sometimes better to be lucky than be smart. And then I had one flyer stock, which I bought for a friend of mine owns the company. And of course that tanked. It was in the sort of in the fintech sector, and technology stocks just got hammered last year. So if you were in the technology area, but part of it is it's just the volatility nature, because if you ever look at the price earnings ratios, their PE ratios were out of control last year. Tesla was over 1,000 PE ratio. Where you at, Jim, until you ran to Texas? But still, I mean, you look at the PE ratios, they just didn't make any sense. And when things don't make sense, why be in it? And I think that's the only way you can beat the S&P 500. You got to work with the S&P 500 and then start culling it down to maybe your favorite 100 or favorite 10 of the S&P 500. And Tesla wasn't one of them, and they're in the S&P 500. So that's the problem I have with the S&P 500 is that you do have some bonehead stocks that are that are in there. But to do that, Sasha, to do that and get the returns, you've got to work hard at it. And see, this is the big problem I found with everything, with chess and everything in life. People don't want to work that hard to get the result. But unfortunately, that's all you can do. You got to work hard. So if you got those great returns, there's only one reason, Sasha. You worked at it.
But I work hard. I work hard because I love it. And
you like it. I know. That's what I'm saying. But that's the reason you got those returns, is you worked it. A lot of people, they're just not willing to work that hard to get those returns.
Yeah, because they don't love it. They don't care about it. And then in that case, it's better for them indeed to buy S&P 500.
I agree.
And
if you're not going to work it hard, buy the S&P 500 index. You'll beat 80 to 90% of the money managers out there right off the bat.
If you get a stock tip at a cocktail party, it's too late.
It's true. Or if somebody just tell me, if you see it in the Wall Street Journal,
Yeah.
you're too late.
Yeah.
In other words, the stock went up. You saw it.
Yeah, that's right. Yeah.
You're too late. You need to get in before.
By the way, Nick, I have a great news for you.
Oh, you do?
It's a little bit outdated by now, but only about a week ago, the price per earning ratio for Tesla, it was not 1,000. It was not even 100. It was
Really?
40.
40?
Yeah, well, okay, it went now, it had a great run up in the last few days, but they have great earnings reports or so on. So
Yeah. So
now it's probably not 40, it's probably 60 or maybe even
Yeah.
75, but still it's not 1,000.
yeah. 40 is looking more reasonable for a technology.
It is. Yeah.
Than
Yeah,
1,000. 1,000, I couldn't see it, but at the same time, you can't short it because you had all the crazies out there.
No, you
Yeah.
can't.
So you're in a situation that you're going to fight the crazies if you short it, and you don't know how long the crazies are going to be in. But you certainly couldn't buy it, because if you buy it at 1,000, you're one of the crazies. So Tesla became what I call a dead stock. It just sits there in dead land. You know.
Well, they had earning report, and I couldn't ignore it. I don't love Tesla and nothing at all.
Was it earnings or revenue? Because what he did, from what I understand, what Tesla, the CEO of Tesla, I think it's this guy Elon Musk. You know him,
Yeah.
Jim. Okay, he's one of your buddies, not mine. But besides from bailing from California because you don't want to pay your crazy income tax, he moved to Texas. He also discounted his cars so he could compete with the other dealerships out there, and that'll bring a lot of cash in, but doesn't necessarily mean profits. So I think that's yet to be seen.
It's going to be much more competitive.
Yeah.
But the other thing that we pay attention to, at least I pay attention to, is like, as Sasha was talking about it earlier, with the pressure that people are on to make money. A lot of times the fund managers or the corporate managers, or even the Yale University managers, they have to report to either shareholders or a board or somebody, and they make quarterly reports. And so they want their investment to look good right before they make their reports, these boards. And so that's when they can sometimes fool the observer by buying or selling to make their portfolio, make their quarterly report look good. So don't be fooled by that quarterly type change. It's the underlying fundamentals that I try to pay
Jim,
attention to.
what you are talking about, it's what called in industry a window dressing.
Yes.
So there are a lot of different techniques, which some of them I can talk about here, some of them I will not talk about here, but there are a lot of different techniques used by professionals to increase their so-called returns to investors. Now, a very interesting thing about when we're talking about PE ratios, if you take all the leadings, if you remember companies like Advanced Micro Devices, which reported yesterday, it was a spectacular report.
Yes.
Stock went up. I had at first naked position. I had 500 shares, and then I bought another 500 shares, but now the covered calls. So now I had 500 naked and 500 covered calls. I liquidated all my positions on AMD today after they continue to go higher after yesterday's report. So I've made a very substantial, percentage-wise, very substantial return on that position. And that gives me more freedom for possible errors later on. Here, obviously, I'll have errors, but now I have some kind of a cushion. And as I said before, probably a few weeks ago, at that time I made only 70% return from 3 months. So I said that I'm not going to give up easily this 70% return. I will protect them any way I can. So it went up now to 80%, and I'm still protecting it as well. And part of that strategy I demonstrated, I think, last Friday when I went well over 90% cash. And I was right, because by Monday, market went down. And when it went down, I started to establish position in AMD and a few other. Now I have position in Amazon because it will report tomorrow. So I did the same strategy as with AMD. So there are a lot of opportunities on markets. It's just amazing how many different strategies. On some positions, for example, lately Pfizer went down big time. So how would I react to that? I sold, I think it's March 17 puts on Pfizer. So I got tons of premium. And now I don't care either way. I will be exercised. So I will get Pfizer at very cheap price, actually under $40. And it was almost 60 a few months ago. And if I will not be exercised, I will keep the premium. So either way, it's a winner. I put some position. Maybe I will increase it even.
One thing I'll say to Sasha, you're playing your own game and you're excellent at it. One of the things that I would like people that don't have your expertise and your interest and your love for investing, when you trade stocks on the short term, you get hit tax wise much harder than if you hold it. Because when long-term capital gains, and someone living in California pays attention to this, if you're in North Carolina, you don't have to worry so much. But I pay attention to the tax bite, and so I like to hold things until it's eligible for long-term capital gains before I sell them.
Right.
Well, I'll tell you, sometimes it's better to pay tax on your gains than
Yes.
losses.
But notice he's in Canada.
Warren Buffett said that in his entire career of investing, he has never seen someone turn down a good opportunity because of the tax consequences.
Yep. I agree with that.
Agree,
Right.
100%.
But Jim, you're going on to the philosophy that Warren Buffett has is to buy and hold forever.
Yeah,
Which
right.
also, if you think that way, then all of a sudden you're
Tax
going
implications.
when you liquidate it, it'll be long-term capital gains. When you make money, it's unrealized capital gains, which means you don't pay taxes on it. And I think that's one of the biggest boosts investors have in real estate and the stock market is you can accumulate large amounts of assets without having to pay taxes on it, because real estate works the same way. When the values go up, you have unrealized capital gains. When you have stocks and they go up, as long as you don't sell it, you have unrealized capital gains, which is very valuable. And a lot of the wealthy clients I have, then when they need the money, they actually borrow against it. It's cheaper.
I agree with you, Nick. Actually, in my core portfolio, as I said many times, I don't touch it, at least for the last possibly 3 years. I haven't touched it. It's all there, same stocks. Let's see what's happened. Okay, today, one of my stocks, the high yield dividend stocks, Altria Group, it's paying 8.5% dividends. It went up today 2%. Okay, no more than 2. It went up to $2, and stock is only 45, so it went up 4.5% rather, right? Okay, so what will I do? What to sell the stock? And what's happened with my dividends? And then there are some taxes I have to start worrying about. So.
Right.
So I don't sell it. I keep it. So it will go up to $60, for example, right? It was 55 last year and I didn't sell. So let's see it go to 60. Now it could go to 75. So what would I do then? So there's no more 8.5% dividends. It's now going to be rather 3.5% if so. And would I sell it? Okay. Possibly, yes. There must be some point at which I will sell that Altria Group. I'm not going to. Otherwise, it will outlive me. Do I need that? Possibly not. So I will sell it, of course. But I don't know.
One interesting thing that comes out of this discussion they mentioned earlier: the harder I work, the luckier I get. I think a number of people have been credited with that statement. But the fact is, that's true in everything that we do. You are a musician, Sasha, the harder you practice, the better you're going to be. It's not true of buying and holding the S&P 500 by buying an exchange traded fund which tracks it. That takes no effort at all, and it's so exceptional to everyday experiences. Now, it's suggested that people in retirement withdraw 4% of their portfolio. And the market has gone up 6.5% inflation adjusted over the last 200 years. Therefore, people withdrawing 4% are going to come out ahead. And it takes no effort to do that. It's so opposite to everyday experiences. In school, the harder you work, the higher your marks are going to be. The harder you work at the tennis, the better you're going to be at it. The harder you work at music, the harder you work at anything except investing, where buying an S&P 500 exchange-traded fund which tracks it is a simple thing to do. It takes no effort at all, and it gets you more than the recommended 4% withdrawal rate. You'll come out.
Milan, I'll just give you an example, actually, that it all depends what hands you have. For example, I remember the time we moved from the house, and I gave my piano to my daughter so she would teach my granddaughter, which never happened. However, for 5 years, I didn't have piano in my house. I took it back later, but 5 years I didn't. And I didn't touch the piano, and I didn't practice, I didn't play. And I was invited when I was in Moscow in Canadian Embassy to perform. It was cultural exhibition of a Canadian documentary, which was shown in Moscow Movie Festival. So I was asked to perform. And before me, there was a concert pianist who played in that movie. So he played, and after that I was playing. I was playing flawlessly. I could never imagine that after 5 years not touching the instrument, I could still play on that level. But I have a friend of mine who is in Toronto Symphony. If he is not practicing at least one day, the next day he cannot play. So it's all really very individual thing.
Well, it's really quite exceptional what you're describing here, Sasha, because it's been said about musicians, about ballet dancers, musicians. If I don't practice for a day, I know it. If I don't practice for 2 days, my teacher knows it. If I don't practice for 3 days, the audience
knows it.
And what about not practicing for 5 years? I don't know. We'll discuss it at some other time. In the meantime, I would like to thank you so much for today's program. I hope you and our listeners enjoyed it. Have a very successful trading week, and we'll see you next Wednesday. Bye-bye, everybody.
Thank you.